Howdy, folks. Welcome to Liberty Call. Today is Thursday. Woohoo! June 6, 2024. I'm Raymond Dahlman, your humble host here at the Liberty Call. Hope you're having a fantastical day. You see my buddy Jake back here. He is super excited because as soon as we're done here and I get everything uploaded, we're going outside for ball time. Right, Jake? He's very excited. Anyways, if it is your first time watching Liberty Call, if you could do me a favor, give me some thumbs up, a like, share, subscribe, a follow, and press the notification bell. Again, I say smart things once or twice a week, so you got to tune in every single day because you might miss it. All right. Markets were kind of flat today, so they're in the red most of the day. So let's go ahead and check in and see how things turned out for our indexes here in the Americas. Dow Jones finished the day up 0.2%, 78 points, closed at 38,886. The S&P 500 was flat, down 0.02, 1.11 points, closed at 53.52. The NASDAQ was down 0.1%, closed at 17,170. Let's see here. The VIX was down 0.4% today. It's at 1258. Canada up 0.38%. Brazil up 1.26%. And Mexico up 0.11%. Over in Western Europe, Germany was up 0.38%, the UK up 0.47%, France up 0.42%, the Netherlands up 0.51%, Spain up 0.8%, Italy up 0.95%, Switzerland up 0.76%, and Portugal down 0.24%. Russian exchanges both red today. The MOEX down 0.59%, the RTSI down 0.75%, and the overnights, the Nikkei in Japan was up 0.74%, Australia up 0.68%, New Zealand up 0.06%, in China, the Shanghai was down 0.54%, the Shenzhen component down 0.57%, China 50 up 0.17%, DJ Shanghai up 0.62%, Hang Seng up 0.28%, and the Taiwan weighted when it closed on the 5th, up 0.6. All right, so those are our markets for today. Exciting stuff, I know. See, put Jake to sleep. And he's our security watch around here. Can you believe it? I mean, the only thing he ever barks at's the Amazon guy and the UPS person. So anyways, all right, let's get over to the market recap, see what happened today. S&P 500 takes a breather, but remains near record levels ahead of key jobs data. All right. On Tuesday, the S&P 500 took a pause but remained near its record high as investors assess signs of cooling in the labor market ahead of the crucial monthly U.S. jobs report. The number of Americans filing for first-time unemployment benefits rose more than expected, reaching 229,000, up from an upwardly revised total of 221,000 in the previous week. This follows earlier data showing private payrolls and job openings falling short of estimates, indicating a cooling labor market. It's freezing out there. Investors are eagerly awaiting the release of the monthly payrolls report on Friday, with economists predicting an additional 185,000 jobs to the U.S. economy. Wow, that's huge. A slight increase from the previous month. The market has increasingly priced in a 25 basis point rate cut by the Federal Reserve in September. So now it's September is what they're talking about. Remember, it was at the end of last year, it was March, and then it was going to be at the April-May meeting. And, well, we got the June meeting next week, so nothing's going to happen then. So they're pointing at September 17th, 18th, I think is what they're looking at right now. So again, until something negative happens in the economy or the markets or whatever, I just don't see them doing anything. They're going to sit on their hands and wait for an excuse so that they can say, see, we're the heroes. We're going to come riding to the rescue like the Lone Ranger and Tonto and, save us from everything with a 25 basis point rate cut, because that's going to solve all the fiscal problems within the United States. No. All right, diving back in. Meanwhile, NVIDIA, a tech company with exposure to artificial intelligence, experienced a 2% decline in its stock after reaching a record valuation of $3 trillion and surpassing Apple as the second largest company on Wall Street. The broader tech sector also saw weakness, with Meta Platforms and Alphabet Inc. Both experiencing declines. In the retail sector, sportswear retailer Lululemon reported stronger than expected quarterly earnings, leading to a more than 5% increase in its stock price. However, discount retailer Five Below saw a 12% slide in its stock after posting disappointing forecasts for full-year earnings. Victoria's Secret also faced challenges, with its stock falling 4% after reporting a net loss of $4 million in the first quarter, citing caution in the North American retail environment. I guess women aren't buying their sexy panties right now since the economy's a little tighter. Or maybe they're just getting fat and they don't fit in those things anymore. That might be the other thing. Why is there a car pulling around in my driveway? Anyways. GameStop experienced a 30% jump in its stock price after Keith Gill, also known as Roaring Kitty, who sparked the original meme stock rally in 2020, scheduled a live stream on YouTube. Gill is expected to provide insights into his $5 million stake into GameStop. Yeah, the dude has made a killing off of that. It's unreal. I mean, I don't know what he's doing. If he's like, when the price goes up, he sells it, and then when the price goes back down, if he's buying more, or I'm not sure what his strategy is, but he has amassed a huge percentage of the entire company stock across the globe. So it's wild. In the energy sector, crude prices edged higher, but we're still on track for significant weekly losses. U.S. crude futures traded 0.7% higher at $74.60 a barrel, while the Brent contract climbed 0.7% to $78.93 a barrel. So yeah, they're down about $10 over the last 4 to 6 weeks. So I mean, I'd love to see oil prices go down to $40, $50 a barrel. I think that'd be great. That certainly help the U.S. consumer and, be a little bit of a help in the inflation factor, helping bring down energy prices. But, we'll see. The decline in crude prices can be attributed to the decision by the Organization of Petroleum Exporting Countries, OPEC, and its allies to gradually unwind voluntary output cuts starting in October. It's June right now. Seriously, I don't know what one has to do with. I mean, they're very far apart, as well as unexpected increase in U.S. Crude stocks. Overall, the market closely monitored the labor market data and rate cut expectations, as well as performance of specific companies in various sectors such as tech, retail, and energy. All right, has everything there. Let's get into the trade deficit. April international trade. This comes from Strider Elas, senior economist at First Trust. So let's see what Strider had to say. All right. In April, the trade deficit in goods and services for the United States reached $74.6 billion, primarily driven by a significant increase in imports compared to exports. However, rather than focusing solely on the trade deficit, it's more insightful to consider the total volume of trade, which includes both imports and exports. This measure experienced substantial growth in April, expanding to $10.1 billion. Overall, the total trade volume has increased 4.7% compared to the previous year, with exports growing by 5.1% and imports increasing by 4.5%. Also noteworthy, a noteworthy development in U.S. trade is the major shift in trade patterns. During the first 4 months of the year, imports from China decreased by 2.6% compared to the same period in 2023 and declined by a significant 27.9% compared to the same period in 2022. China, previously the top exporter to the U.S., has now fallen to third position, with Mexico taking the lead and Canada securing the second spot. I mean, what's Canada send us? Like maple syrup and like Molson? I mean, outside of that, I don't know. Furthermore, global supply chain pressures have substantially eased in recent years, as confirmed by the New York Fed's Global Supply Chain Pressure Index in April. The index was 0.92 standard deviations below its historical average, indicating a significant improvement. In contrast, 2 years ago, the index was 3.5 standard deviations above the historical average for the month of April. However, it is important to anticipate some temporary volatility due to ongoing efforts of Yemen's Houthi rebels to deter container ships from transiting the Red Sea and the Bab el-Mandeb Strait, which may lead to increased shipping costs. Additionally, it's worth noting that the value of U.S. petroleum exports has once again exceeded imports, marking the 23rd consecutive month in which the U.S. has been a net exporter of petroleum products. In other economic news, non-farm productivity experienced a modest growth of 0.2% in the first quarter, with output rising at a rate of 0.9% and hours worked increasing by 0.6%. This resulted in a slight increase in output per hour. Productivity has shown a positive trend with a 2.9% increase compared to the previous year. However, unit labor costs rose at a rate of 4% in Q1 and are up 0.9% from a year ago. Alrighty. Finally, the report reveals the initial unemployment claims rose by 8,000, reaching 229,000, while continuing claims increased by 2,000 to 1.792 million. These statistics have been factored into forecasting of the official non-farm payroll report for May, which is expected to announce tomorrow morning and is projected to reach 196,000. All right. Good stuff. All right, let's dive a little deeper into the unemployment. This comes from Zero Hedge. Initial jobless claims rise to near 8-month highs. Alrighty. The latest government-sponsored jobless claims report, 229,000 Americans filed for unemployment benefits for the first time last week. This number increased from the upwardly revised figure of 221,000 in the previous week and surpassed the median estimate of 220,000. Notably, there were no significant outliers observed in the report, with Minnesota and California experiencing the highest increase in claims, while Michigan and Texas saw the largest declines. Continuing claims remained relatively stable, just below the 1.8 million Americans. However, it's worth noting that there is an upward trend in claims, with the 4-week moving average reaching 8-month highs. Despite the seemingly solid government data, right, warnings of potential layoffs and job cuts announcements, which are not provided by the government, continue to remain significantly elevated and are on the rise. This situation prompts the question that was raised last week: are all the individuals being laid off immediately finding employment with NVIDIA? Additionally, there is skepticism about the accuracy of the reported data, as there is a concern that it may be revised higher after the election. No, they would never do that. Overall, the jobless claims report presents a mixed picture, with increasing numbers of Americans filing for unemployment benefits, while continuing claims remains relatively steady. The discrepancy between government data and other indicators of job cuts raises doubts about the true state of the labor market and the accuracy of the reported figures. I know, shocking that the government would be dishonest, because there's nothing but honest people in government. All right, last up, got another article from Zero Hedge: why the Fed will pull the first cut to July from September. So let's see, and this comes from Peter Cheer of Academy Securities. So let's see why he thinks that. Peter Cheer of Academy Securities provides an outlook on interest rates, focusing on the 10-year Treasury yield and the Federal Reserve's potential actions. As the 10-year Treasury hovers around 4.3 and 4.5%, Cheer revisits his predictions, considering the potential reactions to potential Fed cuts. He suggests that political figures like Donald Trump and Joe Biden will interpret the Fed's actions to fit their narratives, influencing public perception. No. Cheer also believes that the Fed will implement a rate cut this year to showcase the success of its policies in controlling inflation without causing a recession. Okay. He predicts a 25 basis point cut in July, possibly 50 basis points if the job data is weak, with additional cuts likely in November and December. He expects the Fed to present updated economic projections in June, moving towards 2 cuts on the dot plot. Cheer highlights several factors influencing yields. On the positive side, weaker employment data, resilient consumer spending, and a strong dollar could lower yields. However, he warns that high deficits, reduced foreign demand for U.S. bonds, geopolitical risks, and inflationary pressures from onshoring and energy demand could push yields higher. Cheer forecasts a temporary decline in the 10-year yield to around 4.2% and a possibility of exceeding 5% by year end. He advises investors to capitalize on the current bond market rally while it lasts. Issuers should take advantage of favorable Treasury yields and credit spreads before conditions potentially worsen by midsummer. All right, so Mr. Cheer seems to believe that we're going to have 2 rate cuts this year. Again, I'm not saying that that's impossible. I'm just saying that there's going to be some catastrophe that's going to occur in the economy before that actually occurs. That's my hypothesis. He sees it another way. So we'll see. All right. Well, that's everything I had for today. If anyone needs anything from me, please go to DSAFinancialGroup.com. All my contact information's there. Hope everyone has a wonderful evening. Me and Jake are getting ready to go out and have some fun. So hope you go out and do the same. Have a wonderful evening, and I'll talk to you again next time. Adios.